Welcome to our deep dive into the world of hedge funds and their impact on market volatility. Hedge funds are often seen as mysterious players in the financial markets, known for their aggressive strategies and ability to move large sums of money quickly. But what exactly are hedge funds and how do they influence the ups and downs of the stock market? In this video, we'll break down the basics, explore their strategies, and examine their role in market volatility. Let's start by understanding what hedge funds are and why they matter. Hedge funds are private investment vehicles that pool money from wealthy individuals and institutions. Unlike mutual funds, hedge funds are less regulated and can use a wide range of strategies, including short selling, leverage, and derivatives. Their main goal is to generate high returns regardless of market conditions. Because of their flexibility, hedge funds can react quickly to market changes, sometimes amplifying volatility. Understanding their structure is key to grasping their influence on financial markets. Market volatility refers to the frequency and magnitude of price movements in financial markets. High volatility means prices are changing rapidly, while low volatility indicates more stable prices. Hedge funds thrive in volatile markets because they can use strategies that profit from both rising and falling prices. Their ability to quickly enter and exit positions can sometimes increase volatility, especially during times of market stress. Hedge funds employ a variety of strategies to achieve their goals. Some focus on long and short positions, betting on stocks to rise or fall. Others use leverage to amplify their returns, borrowing money to increase their investment size. Derivatives such as options and futures are also common tools. These strategies allow hedge funds to profit in both bull and bear markets, but they also contribute to market volatility by increasing trading activity and risk. Short selling is a common hedge fund strategy where investors bet against a stock, hoping its price will fall. This practice can increase downward pressure on stock prices, especially during market downturns. When many hedge funds short the same stock, it can lead to rapid price declines and heightened volatility. However, short selling also provides liquidity and can help correct overvalued stocks, balancing the market. Leverage allows hedge funds to borrow money and increase their investment size. While this can boost returns, it also magnifies losses and risk. Highly leveraged positions can lead to sudden market movements if funds are forced to sell assets quickly. This dynamic often contributes to spikes in volatility, especially during financial crises when liquidity dries up and asset prices swing wildly. Derivatives are financial instruments that derive their value from underlying assets like stocks or bonds. Hedge funds use derivatives to hedge risks or speculate on price movements. While derivatives can reduce risk, they can also increase volatility when used aggressively. Large derivative trades can trigger rapid price changes, especially if many funds follow similar strategies. Liquidity refers to how easily assets can be bought or sold without affecting their price. Hedge funds often trade large volumes, which can strain liquidity during market stress. When liquidity dries up, prices can swing dramatically, increasing volatility. Hedge funds may be forced to sell assets quickly, further amplifying price movements and creating a feedback loop of volatility. Price discovery is the process by which markets determine the fair value of assets. Hedge funds contribute to price discovery by trading on information and analysis. Their activity can help correct mispriced assets, but aggressive trading can also lead to short-term volatility. Overall, hedge funds play a dual role, improving market efficiency while sometimes increasing price swings. Hedge funds operate in a less regulated environment compared to other investment vehicles. This flexibility allows them to pursue complex strategies, but it also raises concerns about systemic risk and market stability. Regulators monitor hedge funds to ensure they don't pose threats to the broader financial system, especially during periods of high volatility. Systemic risk refers to the possibility that the actions of hedge funds could trigger widespread financial instability. Because hedge funds often use leverage and complex strategies, their failures can ripple through the market. Regulators keep a close eye on hedge funds to prevent systemic crises, especially when volatility is high and liquidity is low. During financial crises, hedge funds can play both stabilizing and destabilizing roles. Some funds provide liquidity and help absorb shocks, while others may exacerbate volatility by selling assets rapidly. Their actions during crises are closely watched as they can influence the speed and severity of market recoveries. The 2008 financial crisis highlighted the role of hedge funds in market volatility. Many funds suffered heavy losses due to leverage and exposure to risky assets. Some were forced to liquidate positions, causing sharp price declines. However, others helped stabilize markets by buying undervalued assets. The crisis underscored the importance of monitoring hedge fund activity during turbulent times. Quantitative hedge funds use mathematical models and algorithms to make trading decisions. These funds can react to market changes in milliseconds, increasing trading volume and sometimes volatility. Their reliance on data and automation can lead to sudden market moves, especially if many funds follow similar models. Hedge funds operate globally, trading in markets around the world. Their influence extends beyond local markets, affecting international price movements and volatility. Global events such as geopolitical tensions or economic shifts can trigger hedge fund activity and amplify volatility across borders. Technology has transformed hedge fund operations, enabling faster trades and more complex strategies. High-frequency trading platforms allow funds to react instantly to market news, increasing trading volume and sometimes volatility. The use of artificial intelligence and big data is shaping the future of hedge fund management. Hedge funds typically attract wealthy individuals and institutional investors, such as pension funds and endowments. These investors seek high returns and are willing to accept higher risks. The concentration of capital in hedge funds means their actions can have outsized effects on market volatility, especially during periods of rapid trading. Hedge funds are known for their secrecy and limited disclosure requirements. This lack of transparency can make it difficult for regulators and investors to assess their risk and impact on markets. Calls for greater transparency have grown, especially after periods of high volatility and financial crises. Like mutual funds, hedge funds are less regulated and can use riskier strategies. Mutual funds focus on long-term growth and stability, while hedge funds aim for high returns regardless of market direction. This difference in approach means hedge funds can contribute more to market volatility, especially during turbulent times. Regulatory bodies are increasingly focused on hedge fund activity, especially after major market disruptions. New rules aim to improve transparency, reduce systemic risk, and protect investors. The balance between innovation and stability is a key challenge for regulators as hedge funds continue to evolve. Hedge funds can improve market efficiency by identifying mispriced assets and correcting them through trading. Their analysis and activity help ensure prices reflect true value. However, aggressive trading can also lead to short-term volatility, creating challenges for other investors. Hedge funds are often at the forefront of financial innovation, developing new strategies and technologies. Their willingness to take risks drives progress in the industry, but it can also introduce new sources of volatility. Innovation is a double-edged sword, offering both opportunity and risk. Hedge funds can influence social issues through their investment choices. For example, funds may invest in companies with strong environmental, social, and governance practices. Their decisions can shape corporate behavior and impact broader societal trends, adding another layer to their role in market volatility. Retail investors are increasingly affected by hedge fund activity, especially during periods of high volatility. Rapid price swings can impact individual portfolios and investment decisions. Understanding hedge fund strategies helps retail investors navigate turbulent markets and make informed choices. Media coverage of hedge fund activity can influence public perception and market sentiment. Headlines about large trades or losses can trigger investor reactions, increasing volatility. The relationship between hedge funds and media is complex, with information playing a key role in market dynamics. Regulating hedge funds is challenging due to their complexity and secrecy. Policymakers must balance the need for innovation with the risks of instability. Ongoing debates focus on how best to monitor and control hedge fund activity without stifling growth. Future of hedge funds will be shaped by technology, regulation, and market conditions. Advances in artificial intelligence and big data will drive new strategies, while regulatory changes will aim to reduce risk. Market volatility will continue to be influenced by hedge fund activity as they adapt to evolving environments. Risk management is central to hedge fund operations. Funds use sophisticated models to assess and mitigate risks, but unexpected events can still trigger volatility. Effective risk management helps protect investors and stabilize markets, but it is an ongoing challenge in a complex financial landscape. Hedge funds play a significant role in market volatility, using complex strategies to seek high returns. Their actions can amplify price swings, influence market efficiency, and shape investor behavior. While they contribute to innovation and liquidity, their risks must be managed to ensure financial stability. Understanding hedge funds is essential for anyone interested in the dynamics of modern markets. Conclusion: hedge funds are powerful players in financial markets, capable of both stabilizing and destabilizing price movements. Their strategies, technology, and global reach make them influential in shaping market volatility. As markets evolve, the role of hedge funds will continue to be debated and analyzed. Staying informed about their impact is crucial for investors, regulators, and anyone interested in the financial world.